All right, this is just simply a workshop for informational items only. There'll be no board actions taken. We have the treasurer on deck for her presentation, so we'll start with that.
Good morning, Supervisor Watson and Chairman Watson and supervisors and staff. We put together an investment report that we hope is comprehensive enough and concise enough that we can answer questions that you might have. If you have questions during the presentation, please feel free to ask. There will be a question and answer at the end, so if you want to write it down and just get through it, we'll go back to the slide if you'd like. Your choice. So I'd like to introduce Randy Vanderplatz. He's the accountant, and Randy's going to do the presentation for you. So here you go.
Thank you, Treasurer Cox.
Good afternoon, Chairman Watson, supervisors. This is it's going to be really quick and easy. This is about a 10-minute presentation, 10 slides tops. So we'll get right into it. Just wanted to go over just a few things. We're going to talk about investment policy, procedures, reporting, cash flow analysis, things of that nature. First is our mission statement. The reason why I'm putting out this up here is to reference a specific line on here: responsibly investing while providing accurate information and preserving county resources. Very, very important to us that we follow that. We never want to get into a situation where we're risking county resources. You guys will probably know this, so I apologize. Just wanted to make this reference. We are like the bank for the county, just like a bank has depositors. We have assets with corresponding funds and liabilities. As fund balances go down, of course, assets go down, and vice versa. As of December 31st of 2016, and the reason why it's December 31st, as of making of this slideshow, January was not completed yet, so we went back to December. As of the end of December, we had a total of around $180 million in assets and fund balances. And of course, they're always going to be the same. The reason for the presentation was in regards to reporting. We want to be able to give you pretty much just whatever you need. We want to be transparent. So the first thing I want to show you that we have available every single month, and that's the treasurer's report. Well, we currently have probably about 4 years worth of treasurer's reports on our website. They also include the fiscal year-end report for each one, and they're available at any time. We post those right around the 15th of every month, sometimes a little earlier, sometimes a little later. So I'll show you that report right now, real quick. As we go through, this is pretty much the basis of the treasurer's report, is just listing all of the fund balances, what they were at the beginning of the month, their total activity, and then total ending balances. And ultimately, those ending balances, if you were to total all of them, would add up to the total assets as of January 31st. As you can see, there's a lot of them. And the reason why we show you this too is because of the fact that we have, our assets are based off of all of these fund balances, which is schools, fires, special districts. We never know from one day to the next what they're going to spend, so cash flow analysis is really important. We can see, normally what they spend throughout a given year. It's the things that you don't expect, the things that they, purchase, just depending. This is ultimately the page that you'll probably be most concerned about on this treasurer's report. Upper section on the right-hand side shows the overall beginning balance of all the fund balances, plus total activity with the ending balance of, like I said, it's the 180 million. The left-hand side shows the offset, shows the bank balance or treasurer's checking balance, total investments, total cash on hand. And if you were to add all of those up, of course, you can see the two will always match each other. And we will never put this report out if these two sides do not match. We'll always find out why, because if they don't match, there's an issue of some type. So if we go down a little bit further on this same page, this is where we've broken down everything. As you can see up in this investment piece, 153 million, that's all broken down here into the different investment types. We break out Fannie Mae as opposed to other federal agency bonds and treasury notes. They're listed separately. We also have our CDs with local banks. We have 4 CDs with 4 local banks, invested in CDs about $250,000 apiece on those. We also have money in LGIP, Wells Fargo Savings, and of course we list the Lehman piece on here as well because we have that offset within the general ledger. So this piece here is one of the things that we suggest you look at every single month. To show, and there's another report that we have that I'll show you a little bit later on that will give you more detail. It'll list all the individual bonds that we purchase. This is it's an overview of total assets, and this graph actually shows not necessarily from the beginning of the fiscal year to the end of the fiscal year. It actually shows from the beginning of the tax cycle to the end of the tax cycle as far as property taxes. We find this easier to use because usually it begins at its lowest point and ends at its lowest point. So you'll see September is about the time the tax bills go out. You'll see revenue or assets climbing all the way to November 1st. November 1st is usually always the first half delinquent or due date for first half taxes. And then you'll see that level off a little bit through December, January. December is when the full year tax amounts come due. So it stays pretty level through January, February. We have our tax sale in February, keeps that nice and level. And then you'll see it spike right around March, April, and pushing into May, because that's when the second half tax payments come in. And of course, right after that, into May and June, things start to slope down. We have school bond payments that have to be made at the end of June. Plus, around that same time, you have balance of contracts with the schools. Same thing. It's just going to continue to go down. And ultimately, it'll just continue to go down and down and down. We have no tax money coming in at that point. So it ends up in August pretty much at its lowest point. But this is a great tool for cash flow analysis. We have other tools that we use to try to dictate, because cash flow is really based off of, we don't do really any investing unless we have a good tax flow analyzed, because we don't know at that point, well, how far out we can invest. Do we need to invest in short term? Just depending. We do follow policy. There's a written policy in place. I believe that was approved by the board back in '09. We do follow that to this day. There also are ARS rules and laws that we have to follow. We do follow those to the letter. No variation on those. Like I said, these things change really infrequently. As far as the priority of investments, it's always safety first. I can't express that enough. Safety, safety, safety. We invest in agency bonds, which are AAA rated or at least AA rated, so they're nice and safe. Treasuries as well, plus anything that's collateralized. Treasurers checking, the CDs, things of that nature, all really safe stuff. Liquidity really goes hand in hand with safety. We always want to make sure we have enough in liquid assets to make sure that we cover the normal day-to-day activity of the county. Also, maybe even just a little bit set aside for things that we don't expect. And then ultimately, yield is last. We always want to, we want to get a good yield as best we can, but not at the expense of liquidity and safety. We do have internal controls when it comes to investing. Only the Chief Deputy Treasurer and the Treasurer are allowed to make investments with our investment asset management company. They will not take calls from anybody else, just those two. So that's one of the internal controls that we have. And the way that works is we'll analyze cash flow and we'll see, what we can invest, how far out we wanted to invest, when we want it to mature. So what we'll do is we'll call PFM Asset Management and we'll say, we want to invest X amount of dollars. We want it to mature, let's say 2 years out on this particular month. Then they will come back with their suggestions. They'll give us a list of what they've come up with. And they'll say, choose what's best for you. We'll choose what we feel is best. And then they will go ahead and purchase the bond or the investment. And then they'll send us the appropriate paperwork. We'll book it and then we'll track it. Also, as far as we definitely want to report whatever we can to you, whatever you want to see. Like I said, we showed you the Treasurer's report, which is one, and that's monthly. We also have an investment portfolio that we also track, and we can make that available to you too. Those are really the two that we'd like you to see. There are more, so if they don't suit you, there's others that we can provide as well. Our investment strategy, that pretty much it's pretty steady. It can be flexible, just depending. But like I said, it changes with policy. But we'll definitely let the board know if that policy, if we feel we have to go away from the policy or bend it a little bit, we'll definitely let you guys know ahead of time. And like I said, total transparency. Some of the assets that we invest, they fall into 3 terms: liquid, short-term, and long-term. Liquid assets, anything that we can get a hold of quickly. Checking, savings, LGIP, any current maturities that are any bonds that are maturing that month, we consider liquid, or within 2 months we would even consider liquid. Short-term bonds are anything up to 13 months out. That they mature within that time frame. Long-term bonds are anything past the 13-month threshold up to 60 months or 5 years, and that's by ARS statute. We can't go out any further than 5 years. Now we can invest in like, let's say, a 10-year bond, as long as it matures within the next 5 years. Nothing out further than that. And again, like I said, I can't emphasize safety first is our consideration. Safety and liquidity, if you have those two things, you feel confident. Even though you might be missing out on yield, we're very conservative in those respects. Other considerations that we have to look at as well are the political climate, what's happening within the country or even globally. Things can happen globally or across the United States that would cause interest rates to go up or down. So we need to look at that. We don't want to, start throwing a lot of money into, long-term investments if we see that the interest rates are rising. We might want to wait a little bit, wait for those interest rates to get a little higher before we, invest. So we look at that quite closely. Even local conditions, like state sweeps. We never know when the state might come in, start sweeping a bunch of money. That's something that we definitely, need to keep an ear out for. Other things would be even, like, let's say, land values, the tax assessments. They go up or down. I mean, that's going to either increase or decrease tax collections that come in. So we need to keep track of that kind of stuff too, so we can make a good, educated decision when we're talking about investments. At the end of every month, we do run a reconciliation. We tie Wells Fargo reports to the PFM reports and tie those to the GL. Make sure everything ties together and there's nothing, out of the ordinary. Usually if we'll try to net fees against interest, so like let's say the bank fees, if there are any, we try to keep enough in checking to be able to earn enough credits to offset bank fees. So we don't necessarily, hopefully in best case scenario, they would be around zero. But we'll always net things, fees against interest, and then whatever's left over, that's what we allocate to the districts. Like I said, as far as reporting goes, there's numerous reports out there that we can give you. The ones that we suggest are the bond portfolio, is the one I'm going to show you, and then also the investment summary, and also the treasurer's report. But like I said, we'll give you copies of those, and if it isn't something, if you want more, we do have more. So, and so I will show you that one next. This is the bond portfolio. This is updated monthly as we purchase investments. As investments mature, they'll drop off. The first section is we break these up into short-term, which is this first page. You can see all of our short-term bonds. This QSIP number just identifies the bond. So currently these are our short-term U.S. Treasury notes on top, and then of course we have one federal agency bond that is short-term. And then the next section down here is our long-term investments. These are anything, like I said, that mature past the 13-month threshold. Now you'll see some in here where you're going to see a maturity date that is actually, less than, or like let's say this one down here, it matures April of 2017. You might consider that short-term because it's going to mature in a couple months. But when we originally purchased it, it was a long-term bond. So that's why we keep it still in long-term, even though it could possibly mature quicker. And then we scroll down to the bottom, and this is just the summary of all investments and liquidity. It gives you all the different the liquidity investments. So we're talking short-term securities, cash held in custody, the CDs, cash in checking, any cash on hand, Wells Fargo, to get total liquidity. And then we also have the long-term investment total plus the Lehman amount fully recovered. And then ultimately total assets equals the 179 million, like you saw in multiple slides previous to that. So this month all tied together very nicely. Didn't have any issues with it. And so that report is available for you. We can give it to you monthly, quarterly, whenever you feel like you want it. Okay. And that pretty much wraps up that presentation. So hopefully that was enough information. If you have more questions and you want to really get into the detail, you can call myself, Bill Barker, Cindy. We'll get you whatever information that you want.
Great report. Thank you, Randy.
All right.
Questions? Supervisor Bishop.
Do you Will you email this report to all the supervisors if requested, or will you do it without being asked?
We can set it up as a scheduled report to send you at a given time.
'Cause
whenever
I
you'd
would like
Tell
to
'em what
receive
you
it at
said.
least quarterly.
I did set up the treasurer's report. I'm going to send to Jeannie by the 15th of every month. Could come in before or after, but I can always send her the portfolio at the same time. And then she can just, I keep hitting that thing. Or I can send it to you, each one individually, whichever you prefer.
Yeah, that'll be fine. Okay, thank you.
That'd be great. Supervisor Johnson, do you have any questions?
Yes, thank you, Mr. Chair. I noticed you said that you have, what is it, little over $1 million in CDs, is that correct?
Correct.
And what is the rate of return on those?
Currently, just over 1%. For a 3-year term, yeah. Each one is $250,000 apiece.
Why would we have that kind of money sitting on a 1% return?
I'm happy to answer that. I would love to invest in 10% interest, and anyone that has those that cover the Arizona revised statutes, we would love for you to tell us about them. But 1% is what we're earning on our portfolio. That's the reality. We noticed that rates were starting to take a hike, and we are starting to invest out farther. We had most of our portfolio in short term, not out past 2018. For the last few years, because 2 or 3 years was the best. We were really hoping for better returns. The CDs themselves served multiple purposes. The first one is, it was really important to me, because my constituents let me know, to have our county funds in this county being used. And for every dollar that we invest in county banks, they roll over anywhere from 7 to 17 times, which means that they are loaned, they are spent, they are loaned again, they are spent. Things like that happen, and that creates more economic fervor in our community, which is what the purpose of investing in those bonds. They're not lower than any other interest rate that we would get for a 2-year bond or a 3-year bond.
So did I understand you correctly that our total portfolio only makes 1%?
We can get it for you. We haven't recalculated it this month yet, but it's about 1.5% for the overall portfolio.
Right.
And I did want to mention one other thing too, Buster. This is Bill Barker. The FDIC guarantee on those CDs helps us with a problem we have that the jail went through the RICO funds. When they were audited, one of the requirements was that their funds be FDIC guaranteed. They didn't want to hear anything about collateralization or any of the other good faith and the good faith and credit of the United States government business like we use for agency bonds. So this also helps with that. The interest that's earned on that almost exclusively, or it is exclusively allocated back to the RICO funds through the jail. That's another reason we do that. And we'll get you a new overall portfolio calculation soon, but it's about 1.5.
And that we compare every month to the Merrill Lynch benchmarks for investing, and we are well over that, their benchmarks. There are things that we're looking into, just so you know, which is one of the really important reasons that I wanted Randy to let you know that the policy, if anything changes within the policy, if we make any changes to the portfolio as it stands, we're going to come to you. I'm going to come to you, and I'm going to let you know. And one of the things I would really like to look into is municipal bonds. We have schools and fire districts and special districts issuing bonds at 4, 6, 8, 10%. And the other 9 of the other 15 counties are investing in these things, and we are not. So I feel like that's something that we need to explore, and we are. We're exploring the newest bond initiative that we know about. Unfortunately, sometimes these bonds, well, let's just say most times, these kind of bonds are 20-year bonds, and we are not allowed to invest in 20-year bonds. But a lot of the counties, what they've done is been very creative in having a sole source purchaser of the bonds, and then in 5 years, they refinance. So it's an interesting process, and I'm learning as much as I can about it, because I think that if it's the right thing to do, we should be doing it. But it's something that I would bring to you once I learn everything I can about it, and we feel confident that it's something that we want to do.
So if I'm understanding it correctly, is this historically, for how many years have we been making 1% or a little over?
Since 2009 or 10, maybe?
About 8 years.
Yeah, at least.
The last
Yeah.
2.5 or 3 years, it's been about that, Buster. And also, Randy mentioned it earlier, we are in the same pool as a lot of the other counties and other investors, including the state of Arizona and the LGIP piece. And the rates were so low on the federal funds that most people kept their investments very current, anticipating they were going to go up. You don't want to tie up a 5-year bond at a 1 3/4% rate.
If you could get that.
If you could get that, thinking that it may pop up to 2 or 2.5% within the next year or two. So a lot of people, including us, kept most of our maturities within a 3-year period. We wouldn't reach out much longer than 3. That drove the overall portfolio earnings low for everybody, not just us. As Treasurer Cox just mentioned, we beat the Merrill Lynch 2-year bond market. We beat that consistently every month. But that's setting the bar pretty low. We beat the LGIP rate, the Fund 7 rate, which is very liquid. But again, that's a very low bar because they're so current. But we'll get you a breakdown on what the actual returns were for each of the last, say, 3 to 5 years.
Well, and I can tell you, Supervisor Johnson, I apologize, that in 2012, when I was running for office, the interest we earned was 0.99%. So not only have I raised that from less than 1% to 1.5%, I invested in this county. We have extensive detailed cash flow analysis. We took advantage of a bank account, a savings account that had a return that no one knew about, and the banks weren't telling us about. And we found out at one of the conferences, and we invested enough money that we saved ourselves all of the analysis fees on the interest that we made, the credits that we made back from that, and that was in excess of, what about 15 basis points of what we could have earned in the bond market? Yeah. So and we kept really good track of how often that happened. And when that interest was lowered to the percentage that we could get bonds, we changed and started buying bonds. So we're paying really close attention on a monthly basis, a daily basis actually, as to the cash flow, how much we can make, how safe we can keep it, that kind of thing. Obviously, safety is number one, and the statutes we have to always follow. So,
How do we compare with the state's rate of return?
yeah, LGIP rate of return, Pool 7 is,
It's less than 0.5%.
yeah, I was going to say 50 basis points maybe.
But that Fund 7, Supervisor Johnson, is very current. That's what people put in to flush their money through, almost like a savings account. They have other funds that are higher than that, but I don't think they got anything that's going much over the 1.5. So I think we're favorable there, but we can get that for you as well.
Yeah. And there had been a discussion with the board in 2008 that we not invest in anything other than LGIP Pool 7, because we were in Pool 5, higher rate of interest, and we lost $5 million on a Lehman Brothers bond. So even though that was a long time ago, it's still sharp and it still hurts. So we're even more careful and about what we purchase and how long we purchase it than the statutes require based on prior history and what this board has told the Treasurer's Office to do, or advised the Treasurer's Office to do better.
Now, does our cost with the investment company come out of our rate of return, or are we on a flat fee with?
We offset the interest that's distributed back to the districts by the fee that's paid both to the banks, the analysis fees, which are zero now because we're keeping a high enough checking balance, and also the PFM fees. But for purposes of calculating the rate of return for interest, we do not, for reporting back to you guys to show what we're actually earning, so we're talking apples to apples, we will not offset those fees against our earnings, if that makes sense.
Which could be quite positive, a positive reflection if you looked at it from that point of view, because in 2012, this county spent $160,000 on that contract, and now we're paying about
70.
70. So we've cut that in more than half.
On our local bank CDs, did you say that you have that in 4 different banks?
Yes.
Would we be better off going with the one bank who handles our checking account to get us more preferred rates, or with them? Instead of giving it to 3 different banks?
The banks that we gave it to were local community banks that keep their money in Mojave County. Wells Fargo does not do that, and they are our bank. In fact, the deal that I made with, what's the name of the bank? Arizona something, Zion, National something. I forgot the name of the bank, sorry, I don't have it on. It's probably in the paperwork. We made a deal with them that they would keep the money here in Mojave County, even though they're out of Utah. So, yeah, Zion Bank, yeah. That was the 4th bank.
But the other issue too, as far as separating the amounts, is the FDIC limit is only $250,000, and that's per depositor. So like for all of the money that we've got with Wells Fargo, and that includes probably 20 different accounts, including school districts and others, they're all reporting under our employer ID number, and all of that, and that can be, you know, as high as $40 million, is only guaranteed for $250,000. So by going to 4 separate banks like that, we're getting $1 million worth, $250,000 for each account in FDIC insurance, which again helps with the RICO funds, because that for some reason was what the federal auditors wanted. They wanted those funds FDIC guaranteed. They didn't care about our philosophy on collateralization or the agency bonds, which are again supposedly as good as the full faith and credit of the United States of America.
And just speaking to the collateralization for a second, the collateralization amount, for those of you that may or may not know about it, the bank collateralizes whatever, every dollar that we have, $102. Is it 3? 102%, yeah. So for every dollar that we have, they cover 102% of that dollar, and we pay for that. So I'm looking for places that are FDIC insured that we don't have to pay for the insurance. So that was the decision to bring the $1 million here to Mojave County to the 4 banks.
Any further
I guess
questions?
the last, if you could send us a list of 4 banks, because it does concern me with going with the Zion Bank. That's all the questions I had, Mr. Chairman. Thank you, Treasurer Fox.
Thank you, Supervisor Johnson.
Thank you, Supervisor Johnson. Supervisor Moss, questions?
No, thank you. It was a very informative presentation.
Supervisor Angus.
Yeah, I just want to go back for a minute and talk about the idea of purchasing our local school bonds. We spoke about that. For instance, there's one in Bullhead City and Fort Mojave, a $35 million school bond. And what's the interest on that? It's like, what, 4 to 7 or something?
Yeah,
like that?
we're still working
Right,
with
so-
them. They don't have an underwriter that is locked in or anything.
Right,
now.
I know it's
It
in the
just
beginning,
passed.
that's
Yeah.
why,
We want to get involved
we
now.
want- Right,
Yeah.
and I was surprised to learn from you that we don't do it, but other counties do, and it only kind of makes sense because you're keeping that money locally. I mean, our taxpayers are paying it, but they're going to make money on it. So I would appreciate it if we could, find out more and if possible, get in on that.
Absolutely. Thank you. We are with you on that.
Supervisor Bishop,
I don't have anything, but I think Mr. Hendricks does.
Administrator.
And excuse me for coming from a very uninformed perspective, but was it about, you said about 2009 we lost a considerable amount of money. Was that in 2009?
2008.
2008. And that caused us to take an ultra-conservative approach as directed by the board. Is that correct?
Correct.
Okay. Does Title 34 allow us to take a less conservative approach? Is there things that we could possibly do and still be
Within the law?
compliant with the law?
Yes, absolutely, and those are the things that we plan to bring to you.
Okay, and a question was, that I had was, it's my understanding there's other public agencies, and that's what Title 35 addresses is public funds, other public agencies that are doing considerably better at their investment because they have different goalposts that they have to comply with, correct?
Correct.
Like risk pools for the school districts, I understand they're doing 3 to 5%. Do you think it would be to Mojave County's advantage to actually look at all the public agencies' investment strategies and compare them with ours, and then to come back with a recommendation to the board on making, working with our financial advisors and coming back to a recommendation to the board, because we substantially do business differently than we did in the past in 2008. We have financial advisors who aren't brokers, who don't sell their own goods now, and they come up with very good recommendations and not biased recommendations. Is that correct?
That's correct, and they continue to recommend the same things that.
Because we gave them,
Yes.
because we gave them the goalposts.
Yes.
So they're
Yes.
very limited on what they can actually recommend to the board. Is that correct?
That's
Or
correct.
recommend to the treasurer's office?
That's correct.
So, like you mentioned earlier, I think that's extremely correct and commendable that if we do change strategy, we'd bring that before the board. But maybe it's time, since we are only getting 1% return on our investments, to actually look at the goalposts that the other public agencies have throughout the state of Arizona and see if there is another recommendation that we could bring forward.
Absolutely, and we are working to that goal exactly.
Okay,
Thank you. Thank you.
Thank you, Mr. Chairman.
You're welcome. Now I've got a few questions for you. And I'm willing to look at the new goalposts, but I was here in '08, and I'm still a little bit tender from that.
We all are.
Just so you know, I probably won't get real fancy and real loose with that. Question, Lehman Brothers, what's the position on that? Any end in sight when we get it collected and off the books?
There actually is not really an end in sight. They continue to have assets throughout the world, and they continue to sell them. And we now have, out of the $5 million, we've been paid back $2 million. Yeah, so we have a little less than $3 million on the books. And no one can give us a date. They basically said it's going to go on for as long as it goes on. As long as they're selling assets, we're going to get money.
So when those assets are
And it
sold,
comes in it comes in infrequently, and then suddenly 3 months in a row we'll get money, and then we'll get nothing for a year. It's a very interesting,
okay, as long as it's constant, that's what I'm interested in.
yes.
Okay.
And we're also benchmarking that to other counties, making sure that what we're getting is the same percentage that everybody else is getting, and
Okay.
kind of looking at that and making sure that it's all correct.
Who is the person or people that determines the investments that we make? Who's in the office that makes those decisions?
Generally, it's Bill Barker. He's my investment officer. It has recently been a little bit of a few more people involved. We're trying to cross-train and get more people involved in the investing piece. We have 3 other people in the office now. We kind of formed our own investment advisory committee in the office. And everybody comes in with their ideas, and we talk about why and when and where and what. And we talk with Paulina Wu, who has come and trained us and is coming back to train us again. Do some, different training, new economic climate. President has changed, interest rates are going up.
We have Bill making the decisions
Yes,
currently.
that's correct.
And Bill's retiring.
Bill is
And
retiring.
so now we're cross-training a group of people to take a look at this?
We're
that
cross-training a
correct?
group of people until I name my next investment officer. But that, it will probably be me, as it was before when Bill first came, because I had to trust him.
Okay. Now, as far as Wells Fargo and the financial advisors, what advice are they giving you on a daily basis or a weekly basis? Do they provide
Wells Fargo
with
has a
that
number,
rundown?
yeah, Wells Fargo and a number of other brokers send emails to all five of us every day that basically outline what's going on today, what's happening in the economic market, is the interest rate changing, what is the Fair Open Market Committee doing, what are the, did interest rates go up, did they go down, or bonds up or down, and anything that we want to know is available to us at any
Okay.
point.
My next question is having to do with the small districts. And as we approach the late summer, my concern is that these small districts, are we in a position to make sure that Wells Fargo, our main bank, will be performing for those small districts,
In terms of
extending any kind of credit?
lines of credit, the lines of credit are set in June, or in July, and they're based on prior year's tax collections and the current budget. They look a lot to our office in terms of, what do you think, what have you seen, that kind of stuff. They were very clear this last time that they came through with their lines of credit that they were cutting.
That they were cutting?
Yes.
What do you mean by that?
Well, if we have, for example, one of our larger districts had a $4.5 million line of credit. That, once the bank says, here's your line of credit, $4.5 million, they have to hold that. That's assets they cannot distribute anywhere else. So in an effort to lower that amount that they had to hold, to collateralize potentially that line of credit, they lowered that. And I think theirs was lowered to $3 million. And then there were a couple of them, for example, the Lake Mojave Ranchos, they said no. Peach Springs, they said no. Kingman Unified, they said no. So,
Okay, so when these districts are going to requiring some additional capital, what are you going to tell them?
well, I came to you to talk to you about whether or not we were going to invest in any other districts. And we watch that really closely on a regular basis. I get a weekly report that says who's close, what their lowest balance is ever, and who we should be worrying about. And right now, obviously, it's a good time. These are the good times. Money's there. But those are the kinds of things that I've given, calls to Supervisor Angus, to you, Supervisor Watson, to you, Supervisor Bishop. And I think I've called just about every one of you and just said, okay, there's this district we're having a little problem with. And we get involved. We try to get involved early. Because the earlier we can get involved, and not to tell them what to do, but to give them the information so they could make good business decisions. And a really good example of that is Bullhead Unified School District. When I went and talked to them in 2013, they were not very happy with what I had to say. They were living in their credit line. That was the reality. They're not doing that anymore. Because we work together to try and get them out of that. It's, you gotta look at, I got up and I said, there's only two ways out of a budget crunch: make more or spend less. So they started looking at it and really doing something about it. And we were very helpful in giving them every report that they needed. Supervisor Angus was very instrumental in having them come to their office and meet with us so we could speak with them, and things seem to be going well. So we're trying that approach to begin with. I don't want the fire drill that we had in 2013 with Lake Mojave Ranchos. And my assurance to you is I will do everything within my power to make sure that doesn't happen again. But we're not giving out money unless the board decides that we want to purchase their debt instruments. That's the rules. And they all know that because I've written them a letter to that extent.
Great, great. We're going to have 3 or 4 districts that are going to be in dire need of capital before the summer's out. So we need for your office to make sure that they can line up whatever credit they can line up.
Right.
Okay?
Right. We also, you talk about moving the goalposts. that is something I'd like to bring to you and have you decide on a case-by-case basis. And what we had talked about in our office was the specific districts, and this is something that we're going to do before probably April to bring to you, the specific districts that we know are going to be in financial trouble, because we look at all this stuff. We use a lot of historical information. We know what their taxes, revenue is going to be. We don't really know what they're spending, but we know what their trends are. We're going to bring that to you because I would say about half of the counties are investing in warrants, their own warrants, because they make 10% on that money. Is that something that this board wants to do? It had always been a no. So that's something I will bring to you on a case-by-case basis. I'll explain to you, what our background is from getting into it, and the board can decide what to do.
I'll certainly let you bring the information forward, but I doubt I'll change my mind.
Have to give you the information. You guys get to make the decisions, so.
This is not a game. This is dollars that are tax dollars.
That's right.
I know that you're very interested in making sure that we do everything we can for not only our districts, but return on investment. But I was here in '08, and I'm still a little sore over that. The financial advisor that we hired specifically to advise us in investments, are you currently using those people on a daily, weekly, or monthly basis?
It depends, yeah, weekly at least, but it depends on what we need. They're very available to us.
Okay.
They're pretty good with ad hoc reports, any kind of, if we call them and say, we need a meeting, they'll come down, spend the day with us, half a day, whatever we need.
Okay. Are you feeling satisfied that they're
Very.
performing what they're designed to do?
Very, and they're training for free. So, some amazing training that the five of us, I feel pretty confident that what they're passing on with Bill's help and Bill training them and myself being involved, that we will continue to have a very good relationship with it moving forward in the investments.
Well, I would like to thank you very much for your presentation and your continued transparency. I really appreciate it.
Thank you very much. And can I just say, this was Randy's very first presentation ever, and I think he did a magnificent job.
But he did a wonderful job.
Thank you very much.
Thank you. Thank you very much. All right. Do we want to take another quick break before we get into Ms. Lloyd's presentation? You okay?
I'm good.
Okay. Ms. Lloyd.
Should be some background music, I would think.
Yep. Hang on just a second here.
Paperwork for that?
Well, Ms. Lloyd, thank you very much for coming and volunteering your information. As you can see, this is Finance Day in preparation for all the work that you do in budgets and all the heavy lifting that you have to do. But it's fine and nice to know what money we've got in the bank, but we need to know what the liabilities, what our bills are in the future, what we're facing. And that was the reason why I wanted to make sure that everybody on the board was aware of some of the huge liabilities that are down the road for us. And so, thank you for coming today.
You're very welcome. Thank you for having me. I'd like to make a joke, with your permission.
Certainly.
This is going to take more than 10 minutes, but the discussion points that we have on the board for you today include the motion that was made a couple of months ago in regard to some of the primary opportunities that we have to initiate funding sources, some of the statutory authorities that are related to those, as well as address some of the unfunded needs, or at least discuss the unfunded needs and liabilities. From the revenue perspective, primary property tax is obviously our main source of revenue. It creates about 41% of the total needs with a $77 million general fund budget. And again, here I'm just going to kind of focus on the general fund. The revenue options that we go through are not necessarily all-encompassing, but they do provide the best return or the greatest return, if you will, for at least this discussion. The tax current rate that we have for the property tax is $1.96. It is 51 cents below the maximum tax rate of $2.47. And if we levied the maximum rate, the county would receive between $8 and $10 million more than we're currently receiving. In 2012, the rate was at the maximum, and since then, in the intervening years, then that rate was held flat until the prior year, in which case we did a shift between the library and TV districts into the general fund. The maximum rate each year is limited to a 2% growth plus any new construction. And then the other factor in calculating that is the net assessed value increase, which is limited by legislation to 5% plus new construction. The primary property tax, the revenues themselves are really intended for any general county purpose, but the board certainly has the authority to restrict those and limit those use of funds by a resolution. Some of the pros and cons, if you will, associated with the primary tax are that there are certain risks where we've experienced those in recent years where there's been losses, particularly on centrally valued property. We've had some tax settlements that have certainly been significant impact to the bottom line, and we have running about a 10% delinquency. The tax burden, one of the bad items associated with that, it's an unpopular tax, and clearly that tax burden is placed upon property owners at a higher rate for businesses. In looking to historical information and trying to project into the future, it is important, I think, to note that the ratios on the tax itself for non-residential, so this is commercial, agricultural, other types of properties, that the ratios, particularly businesses, have gone down and declined based upon legislation in these intervening years. Their ratio was at the highest 25%, and it's now down around 18%. So the reduction of that has transferred the burden and certainly has made it a little easier, if you will, for businesses at least to comply with property tax. I've inserted a slide just to do a rough comparison of the primary property tax rate for Mojave County compared to the other 15 counties, and you can see that we're at the lower end of that scale. And moving on to the next main area of opportunity, if you will, for funding sources, looking at excise tax. Currently, Mojave County has a rate of 1/4 cent, and that is the lowest in the state for the combined excise tax rates. We generate about $6.3 million from that, and it's restricted right now to capital facilities project. The board adopted this rate in August of 1999, and it sunsets in December of 2019. By definition, while this is dedicated to capital facilities, it really is by definition a general purpose tax because the voters did not approve that tax. The board may extend that, they may modify the rate. You can go all the way up to 1/2 cent for that by a unanimous decision of the board based upon current legislative authority. The maximum rate, if you levy the maximum rate for sales tax, would be $12.6 million, and again, that's twice as much as we're currently receiving. And we've had discussion about what are we going to do with the balance of the court project. There are other pending capital projects or even other county purposes that will extend beyond the sunset date of 2019. And what does this board, what are you comfortable doing? There are clearly risks associated with the sales tax as well as the property tax. They're both susceptible to economic cycles. The sales tax, much more so than property tax. And there is an over-reliance on sales tax for the local, I'll call it brick and mortar retail, for lack of a better term. And we're very dependent on tourism and construction growth. So if a business grows, we're doing great with the excise tax, and if a business contracts, then obviously that reduces the revenue for the counties and cities and the state. Legislative exemptions that have happened over the period of years and internet sales have dramatically impacted revenue associated with excise tax. And again, the tax here is a transaction privilege tax in Arizona. It's generally passed on to the customer, but it is incumbent upon the transaction itself. Amazingly, it's a very widely accepted tax, although it is regressive. And I think the reason why is because that it's favorable is because it's shared by everyone. Property taxes are in effect too, because they're passed on to in the customer price that is paid. For landlords, it's passed to tenants. However, I think it's more understood for the excise tax is more easily understood that you're paying at the point of sale. A chart depicting the comparison of the combined sales tax rate, Mojave County compared to the other counties, again, shows us at the lowest point. And this does include the various tax districts that they would levy excise tax rates.
Could you go,
Go back?
Could you go
Okay.
back to that? Thank you. So Mojave County is the absolute lowest in the combined total of property tax and excise taxes?
This slide is only the excise tax.
Okay.
So the blue bar, I hope you can see the colors there. The light blue bar is, let's see, can you see my mouse on your screen?
Yes.
Okay. So this is the county excise tax.
Okay, I
So
see.
anything blue. So for example, Maricopa County does not have a county excise tax, but they have a jail tax and a road tax, which causes their rate to exceed Mojave County's.
Okay, thank you.
Okay?
Yeah.
And we can get to I'll get to the combined. I have
Okay, thank you.
Okay. And moving along, potential revenue sources. So these are revenue sources that Mojave County does not currently have. We've explored quite a few of these, so I'll just try to go quickly through these. We could adopt a capital projects excise tax. It would require a unanimous board approval just to submit it to voters. The earliest election date for that, if it went to the general election, would be 2 years from now, and it wouldn't become effective until July of 2019, if that were voted by the voters. The maximum rate, again, is 0.5 cent with a 20-year term, and it would be restricted to whatever the ballot uses were presented for. Coconino County right now is the only county, I believe, with this tax, and they levy 1/8 of a cent for this tax. Another option, one that's been discussed a little bit, is a property tax override. This would require a 2/3 approval of the board just to submit it to voters. And again, the dates when it could become effective, if it were approved by voters, are similar in all of these cases. The maximum levy rate is actually set by you, and then the terms could not be less than 2 years and not greater than 7, although it could be renewed by the voters after 7 years. Mojave County did use a tax override in the 1990s, as it was a 7-year term. If it were levied right now, it would be the $12 to $13 million. And I'm not certain, in fact, I feel pretty strongly that it wouldn't be permitted right now because we are not up against the maximum tax rate. Moving on to the transportation tax, we have at the bottom of that slide, let's see, 1, 2, 3, 4, 5 counties currently have a transportation tax, and in some cases they share that with cities. The maximum rate on a transportation tax is 0.5 cent with a 20-year term. The unusual characteristic of this tax is that it would have to be deposited into a regional or a public transportation authority, such as WACOG. So in looking at this and discussing this with some of the other counties involved, they have deposited these with their COGs because there is a joint interest in the region and not just the one particularly governmental entity. The next opportunity would be for a jail district. For a jail district, you could consider either a property tax district or an excise tax district. One of the items to really kind of dissuade an entity from going with a property tax district would be that the maximum rate is limited to 20 cents per hundred of assessed and would generate about $3.4 million a year. But the budget for the jail right now is between $12 and $13 million. So this would certainly, I don't know if it would be worth going to voters to ask for a district and then not have it cover the cost of that district. Apache County, right now, as far as I know, is the only Arizona county with this type of district that's funded by property tax, and they're levying the maximum of 20 cents. The other option for a jail district would be the excise tax. The maximum rate there, again, is the half cent. Interestingly enough, the jail district board, which I would assume that that would be similar to the other county tax districts, would be the Board of Supervisors, but the board could levy a retail use tax for electric and natural gas customers that are retail. I don't know how much money that would be. I don't have any information on that, but that was kind of an unusual item in the statutes. There are several other counties that have a jail district with use of the excise tax. Maricopa is using 1/5 of a cent, Yavapai the 1/4 cent, and all the others the half cent. Public health districts are another area where several counties participate and have expanded into. There's the property tax and the excise tax. The maximum rate for a property tax associated with a health district is 25 cents. It could generate about $4.3 million. The revenue here, there's a restriction in the statutes that whatever is adopted and presented to voters, the expenditures must be greater than or equal to 50% of the last 3 years' average of expenditures. And I would assume that the purpose that was written was to prevent an entity from lowballing the budget of having to spend, we've been spending $4 million, but now we're only going to spend, $1 million on public health. And by doing that, then they would have the opportunity to basically eliminate public health available to their citizens. So I think that was probably the preemptive reason. I'm not positive, but it kind of made a little bit of sense. The Apache County is levying a little bit less than the maximum, but all the other counties that participate, Coconino, Greenlee, and Navajo, are levying 25 cents. Then there are 2 counties that participate in the excise tax for public health. That's Pima and Yuma. And they are levying the maximum rate, which is 1/10 of a cent on the eligible taxable sales. That could generate about $2.5 million per year, and otherwise the restrictions are the same. The first effective possible date for that, if approved by voters, would be July of 2019, so definitely more than 2 years out. Another funding source, I'm not certain what the amount the county could recoup on this if adopted, but you do by statute have the authority to levy a use tax on electricity that's sold to retail customers. Again, the maximum rate is 1/2 cent on transactions. And if adopted, the statute does require that the revenue is used to support county-wide services and not necessarily be restricted. So in summary, based upon our current revenue structure, that we do have near the lowest of our combined property and excise tax rates. The 3 lower counties are Navajo, Apache, and Greenlee. And here is a slide to depict the overall impact that we have on our taxpayers. I've included on this slide kind of a cheat sheet to make a conversion from a property tax to an excise tax. So for example, if we were going to say, well, we have a quarter-cent excise tax right now. It raises about 6.3 million annually. What would that equate to for the property tax? And it's 37.5 cents, about 40 cents of our property tax rate would be offset with the sales tax. We're currently levying the $1.96. If that were, it's not possible by the statute, but it would equate to about 1.33% for an excise tax. And then just kind of a rule of thumb that for every 10 cents that we levy in property tax, it would be a 15th of a cent in excise tax, and it would create about $1.7 million. So with that, anything I need to address before we move on to some of the expense side? All right.
I just have a clarification, Mr. Chair.
Certainly, Supervisor Johnson?
Yes, thank you. Just so you make it clear to the public, you were talking about the property tax and the commercial went from 25 to 18. And that was picked up because the size of the pie stays the same. So that was picked up by the property owners. When everybody keeps talking about we're lowering it on business, put onto the property owners, is that correct?
Yes.
That's all I had, Mr.
Okay.
Chair. Thank you.
Before you go on any further, could we go back to that one slide where we
This
had
one?
Mojave County?
Okay.
So we're the fourth from the bottom, but we're one of the largest counties in the state. We've got to do something. If you'll go ahead, go on.
Okay.
It's just astounding to me that our situation is such that we're one of the largest, but yet we're one of the lowest in taxes. Go ahead.
Okay, thank you. An overview for the liability challenges that you're facing. We have had many years of continued cost shifts and sweeps. We've talked at length about some of the centrally valued property losses that we've experienced, and not just Mojave County, but a lot of counties have been involved in those. Budget reductions, we've had employee reductions, but we basically overall, at this point, after kind of achieving a balance, that we've struggled to get off the ground and remaining competitive with a wide variety of things, but some of the maybe most important items that we've talked about and touched upon have been compensation and retention and recruitment of our employees. The roadway conditions has been certainly a topic of discussion and concern. We've talked at length about public safety pension, and now we're adding the elected officials' pension on top of that. And then our building maintenance issues and the need for some reserves to be set aside for future maintenance items. We understand, and I understand in presenting that I know that whatever decisions that you make on behalf of the county and the citizens, that we do understand that the funding mechanisms that you want to look at and discuss need to be affordable and acceptable. In no means, if we make any change that will increase anything, will it be popular. But whatever we do, we need to make sure that we're picking the best options and in an amount that's sufficient to pay off some of these and pay down some of these liabilities over a period of time, and then also to sustain and to promote economic development through the region. So in kicking that off, compensation, I've created here at the bottom of this slide just a general scenario so that you have round numbers to put into the back of your head, that overall, just for salary in the general fund, including our payroll taxes, does not include health insurance, which would not change depending on what people are paid, but just the salary and associated taxes. A 1% pay increase is going to cost about $400,000. And it goes on up 2%. I've put in just up to 5% would be $2 million impact per year. Across all funds, we're looking at about $68 million spent in salary and payroll taxes, and 1% increase, then obviously it would be $680,000. I don't need to give you a lecture about the value of our employees. You all know what that is. So we've come up with just a couple of, in the report, just basically like 3 items, different scenarios. There's many of these. These are just to get you some ideas of what possible options would cost. So if we did a class comp study, which has kind of been kicked around, and I don't think that there's a unanimous agreement on whether or not we should do that, but we're estimating that that would cost up to $500,000. It's a lot of money. Based upon that study, right now, I'm assuming, this is really me, I am really assuming that the salary scale itself would need a 10% market adjustment. So if we implemented a 10% market adjustment, assuming that it takes at least a year to get this study completed, we do a 10% market adjustment in the first 2 years, and then provide step increases, and depending on what the outcome of the study, what the recommendations would be, whether it's a step increase or it's pay for performance, but regardless, you're probably looking at some sort of combined increase combined with CPI. So based upon those assumptions, just did a calculation to move the 10% out in 2 years, 2.5% in the subsequent years, and I hit kind of a break-even point in year 5 and 6, whereby the cost escalation slows as people hit the top of their ranges, and we also would reduce turnover. So at the maximum year of 5, you would be spending $6.3 million, so to speak, in year over year after you've done essentially 15% increases. And then it would be more sustained at that point. So you wouldn't be looking necessarily at another $1.5 million increase in subsequent years as that, okay, I'm getting some head shakes, like that makes sense. I laid it out here in this format so that you could see how my calculation really is year over year. So let me give you an example that I didn't put it in the report, but hopefully this is helpful. If not, you can just say, please skip. But I said, well, let me look at a sheriff deputy position. Assuming that their base rate is $40,000 and we don't do anything in the first year, but we contribute 5% more in years 2 and 3 to do this salary scale adjustment. In year 2, the officer would be paid $42,000, and then in year 3, the same $2,000 for the term of employment. If in year 3 we increased another 5%, then the salary would go to my mouse is taking off here, $44,000 a year. A 2%, 45, a 2.5%, $46,000. So overall, per year, the cost multiplies. And I wanted to prove that that is good math by saying, well, what is a 15% increase on $40,000? Well, it's $6,000. Add that to my 40, get $46,000. And is that what I predicted? Yes. So simple math or a little bit more complicated, you end up at the same amount of money. So that is a scenario. We could do something else and just basically address some critical position needs and not do compensation increases and just designate an amount. So for example purposes, pick $500,000 again. By the end of year 5, if we allocated $500,000 each year, we would be spending $2.5 million in year 5 going forward just to address some of the critical needs positions. I'm assuming that those are basically in public safety and health based upon, some of the known factors that we already have and what you've already been approached with. Another option would be to reinstate 2.5% step increases. Doesn't have to be step increase. It could be based upon something else, but just to budget 2.5% additional. Again, in this case, we would essentially, on this example, eliminate the comp study and just say, well, how much is that going to cost us if we did step increases or provided up to 2.5% for eligible employees? Again, $1 million a year And for this purpose, I didn't recalculate on the prior year, I just did straight line. But after 5 years, you're looking at $5 million. So of any new revenue source that you had, and you dedicated in year 1 $1 million, in year 2 $1 million to address step increases, by year 5, you're spending quite a bit of new revenue on overall a 10% increase in those 5 years. So in order to make that decision, and for me to recommend that type of decision, I would have to feel pretty confident that the tax revenues, no matter how they're going to come in, are going to support the ability to continue to pay for that. Otherwise, it is not affordable. An example of the 2.5%, again, I picked a deputy position. In year 1, they start at 40 as a base salary. We would give them 2.5% increase, $1,000. That would continue over the term of employment. If there was the person were eligible for another increase the following year, and so on and so forth. So that increase would equate to, about $45,000 by the end of 5 years. And hopefully, the purpose of that being that it would aid in reducing the turnover within some of those critical staff areas, well, across the county, everywhere. So those are some basic scenarios for compensation. Another issue that's come up, and I believe that we're going to be challenged with, is understaffing. Not just the compensation, but that we need to add back some critical positions in certain departments. Specifically, as noted, the sheriff's office and then criminal justice departments. So I came up with a scenario, what if we did that over a period of 5 years and we added back 3 positions next year, 4 more, 8 more, a total of 15. Over a window of time, based upon $1 million, divide that by 15 positions, it's an average of $67,000 for the cost of salaries and the benefit. The next topic, we'll do the unfunded PSPRS pension liability first, and then following that, the elected officials. We know that our pension liability right now is about $20 million. It's about 52% funded. We're going to have to amortize that over the next 20 or 30 years. We're not required at this point by any legislative action, but I wouldn't be surprised if that isn't coming down the road if entities across Arizona do not address this, including the state of Arizona. Right now, if we contributed an extra $1 million and paid that down over 20 years, we would reduce our liability by about 2.6%. I guess that's not really an about amount. No, that's a pretty finite number, but between 2 and 3%. It would also reduce our annual contribution rate about 2% each year. Some information that I provided to you in the report assumed that we could pay that over 25 years and have to spend $800,000 of new money to achieve that result. I provided as backup documentation in the report quite a bit of information, and I can walk through that with anyone at any other time. I don't want to go through a lot of that necessarily right now and bore you with all that, but it was quite interesting getting into some of the actual detail of that. And it did support, in fact, what the sheriff has previously said. We had 68 people paying into the public safety pension liability in 2016. I believe that there were 7 people in drop, and we had, now I can't remember what the number was, 40-some people that were actually retirees in that program. For EORP, we're currently paying about $650,000 a year into EORP. Compared to public safety, we're contributing over $3 million. So for the elected officials, it was a much smaller amount. However, based upon the information that we've been able to retrieve on the Hall case, and you're familiar with that, that the best-case scenario that was implied to us by the Public Safety Retirement System, which governs the elected officials' pension, that if we were allowed to pay that liability over 28 years, it would increase our contribution that we pay right now from $650,000 to $1.5 million. That's $800,000 a year. So we know we have a liability for the public safety of $800,000, and now we're about to inherit what I believe to be $800,000 for the elected officials that were participating in this program prior to 2012. And then 2012, and then anybody new through 2017, it's a different scenario, but this is on anybody who was grandfathered in. The worst case right now that was provided to us from Mojave County would move our annual contribution up to $3.5 million. That's just a huge increase. It's more than what I can really kind of wrap my head around right now. So I'm going to choose to ignore that unless that actually happens, but it's just huge. So as we learn more about that and we get more finite numbers or better informed on that, obviously you'll be informed as soon as we are. In fact, you may be more informed than I will be. You may be informed first and you can let me know. But we'll continue to trudge down that road together. So moving on to our topic of the TV and library district, we currently have those funds structurally unbalanced, whereby expenses for the library district, expenses are exceeding revenue between $1 million and $1.6 million each year. We've been doing that for 2 years. The library operating fund started in 2014 with $5.7 million, and we would estimate that we're down to about $1.5 million by the end of this fiscal year. And we need, I guess, a decision going forward. Well, I don't guess that. We definitely do, but I don't know what the outcome of that will be on your behalf. We could return 10 cents or some portion of, or the Board of Supervisors would be tasked with making an alternate decision. We do have fund balances in the building fund, and you can make other service decisions if you would like. For the TV district, it's similar, where we shifted 5 cents over to the general fund, essentially. That fund balance is going down slower. Naturally, we're spending less in that fund. It's dropped about $1.1 million, $1.2 million over the last 3 years. And again, we'll be looking to you to make a decision whether you want to return a portion of the rate, all of the rate, for structural balance in the coming years. And then, of course, we've talked about, since I've been here, that we may need to have certain designated reserves for post-closure cost. The next item to review and some of the challenges that are facing you, and again, this is not an all-encompassing list. I've just tried to capture some of the big items that this board has to address in the next year. Or in some cases, you may be able to kick some of those out 2 or 3 years, but certainly by the time that your 4 years expires here, you'll be looking at all of these issues. A code enforcement program would basically be establishing some initial funding to go out and proactively enforce cleanup of private property, and then also enforce higher zoning priorities and property maintenance violations. Attached in your backup support was a memo and some detailed information provided by Development Services, but we would be able to recoup some of the cost after a period of years. I don't necessarily believe that those would be immediate. Some of them would be, but possibly some of the larger ones that would have to go to lien recovery could be pushed out into future years. But as that program, if it were implemented and as it progressed, there should be a reduced cost as property owners became more compliant with the ordinances and the codes. The department estimates that we would need to have at least 4 people assigned to this program to get it really kind of running, and up to 11 employees for a full program, including the attorneys to prosecute the cases. I've cited the authority that are referenced in these variety of codes and then the Arizona statutes. So any questions on that? I'll move on. Oh, gosh. The jail facility, what are we going to do with the jail facility? Right now, we're paying maintenance that's running up to $750,000 a year. It's between $550 and $750, depending on some of the items that happen over there. We're paying that from the quarter-cent excise tax. So if we pay that off, whether we pay early or whether we pay that to term, Mojave County is going to have to absorb that cost within the general fund, unless a jail district were approved by voters, and then that would be a separate tax to pay for that. But assuming that we continue, we need to find a revenue source and a means of taking that into county funding. And we need to do this fairly quickly. The reason being that if we do the prepayment of the debt, we will save close to $600,000, which we've calculated into $600,000 that will be made available to pay for the construction of the jail, of the Law and Justice Center. We need to get out, if we pay early, we need to get out and get bids on either a maintenance contractor that's been secured, or the security clearance has been approved by the state. We need to, if that doesn't occur, or we choose not to go that route, then, and use that, our county staff, then we would need to get them to training that are specifically associated with some of the functions that occur at the jail, and then also make sure that we have security clearance on all of those employees. And then we need to let the bank know that we intend to pay off the jail early, and be prepared to absorb all of that within the budget. That allows us, if you will, to dovetail into overall all the buildings that in 2014, up through 2014, Mojave County was contributing about $600,000 to $700,000 a year into building maintenance capital project items. So these were not new projects. It was really maintenance of the buildings themselves that were fairly large in size. Some of them are small, but it can include new flooring, repairs of air conditioning, things like that. In 2015, the funds were cut to $50,000 for the general fund to pay into that fund, and the last 2 years, we cut it to zero. And those items, maintenance items, have been surviving off of their carryover balance, but we expect that this is going to go to zero at the end of this year. We do need to have that discussion with how we're going to fund ongoing maintenance, not just of the jail, but of this facility and all of our other facilities. And again, we're spread out into 3 major cities and north of the Colorado River, so there are it's quite a large, expansive area, and there's a number of projects. For internal services, not that you need a reminder of internal services, but we have utilized the fund balances that were retained in those funds over the last 2 years to essentially cover our cash flow into the general fund. It is a best practice to ask for 60 days of working capital in those funds, as well as have a funded 5-year capital plan, and then have a little bit reserved for contingency. Our goal with internal service funds would clearly be to have rate stabilization, to eliminate any large swings from year to year, and allow you as the board to know what you're planning for the upcoming years. It's also a best practice to establish a rainy day fund. A rainy day fund essentially allows you to have the flexibility to be able to weather economic downturns, to absorb unfunded mandates, and make decisions about those type of activities, including emergencies, without having to go out to taxpayers and immediately raising taxes or eliminating services, at least for a window, so that you can make decisions about what is necessary, what tools do you have to address the needs, what tools do we want to fight with for unfunded mandates, and those kinds of topics. We don't have a rainy day fund right now. For economic development, this came up this past year. that the board may want to consider some sort of long-term funding to participate in opportunities that may arise with qualified entities. Right now, if something came up, you would be looking at basically contingency or coming up with some other really great plan. For the Law and Justice Center project, we've been advising you that you will have about $21 million in total for that project, pending that revenues continue as they have the past few years and that we don't see funding shortfalls based upon an economic downturn. But all things status quo, a total of about $21 million, includes paying the JLF the debt early. So from the $21 million, we would anticipate reducing that by the $2 million that we're spending right now for the design. Really, when we've been talking about what might this facility cost, we're really probably looking at $25 million instead of $21 million, including all the furnishings and fixtures. So we are going to be back, if that turns out to be the case, and I'm by no means giving anyone who's designing the project a green light to exceed $21 million. But reality is that it could be higher, and if that's the case, then the board will need to find, well, I'll need to find a funding solution, and it needs to be something that you could live with. There are also other unfunded facility projects that were on the outline when the quarter-cent sales tax was adopted in 1999. That includes the animal shelter, the morgue, and some substations for the sheriff's office. There could be more. These are just some of those, the main three that I'm aware of. For the animal shelter, you've actually had a committee that has been meeting for the last year to look at a variety of options, and they've actually included some of the funding options. So combined with some information that the Parks Department is working on with that committee, it looks like if we spent $1.5 million, we could get a lot of that from specific grants and then donations. Another area of discussion that you've had has been our water resource preservation, how we pay for that. For the efforts that are being looked at right now, we're looking at IGAs with City of Kingman as well as flood control monies, but we are also spending about $200,000 a year on legal fees and professional services. So we needed to add that to your list of things that you need to think about and budgeting for in the future years. Road funding, augmentation of road funding. The examples that Public Works has provided to me, Director Latowski gave us a report that was included in your backup material that identified some of the deteriorating conditions. For the chip sealing itself, the standard practice is that you would chip seal a road, a paved road, once every 5 years. Currently, Mojave County is using a 25-year cycle instead of a 5-year cycle. For the major regional highways and arterial roads, redoing those roads is once every 15 years, and we have indication that those are on a 33-year cycle. So we've noted that 45% of those regional highways may have reached the end of their life and are needing reconstruction, and then 14% of the roads exhibit poor conditions. The road improvement or any expansion projects right now are limited to using federal funds and applying for federal funds. And then we also, within the CSA discussions and other ACO, NACO, not NACO, but ACO, those discussions where there are some pending bills on road taxes, to modify road taxes, and we're awaiting, the outcome of all of those. But we'll see where that takes us with the funding. It's also important to note that the road department has a lot of turnover, so it's not only public safety in that area, that the road department has experienced greater than 100% turnover, and they do have a 30% vacancy rate. Moving on to the next item, you all are well aware of the state cost shifts and revenue sweeps. I won't bore you with all of that again. I did want to note that At this point, it feels like these cuts and sweeps are permanent, and if they are going to be permanent and considered permanent, then the decision about that is pushed to you at the local level to determine how we're going to handle that long range. Other unknown impacts that you may be looking at, obviously, are any tax settlements or the litigation that we're currently involved in, and the outcome of that is unknown, but estimable. The primary reason for this, again, is the centrally valued properties, and it was interesting to learn, the assessor's office kindly delved into that a little bit more and found that much of the information about CVP is self-reported, so it's not necessarily Department of Revenue going out and making these assessments, and I had been blaming them essentially, but a lot of times these are self-reported, and then subsequent to their self-reporting, they've come back and sued for a lower value. So let your mind wander as to what the purpose of that is, and it does make a little bit of sense from the business perspective, but was quite interesting to learn. So there's an area where we don't have to blame the state for that all in total. We are looking, at over $1 million probably within the next 2 years potentially, and it could continue to go on where some of them apparently it takes 2 years from the point that the settlement is filed, and then you continue for 2 years before the amount is reset. So there's always the tax settlement and then subsequent tax litigation for at least 2 more years, if that makes sense. And then I guess the last item that I had listed was the county fairgrounds facilities. I don't have any information on that particularly, but it had been an item that has come up from time to time of discussion at the board level. And then also, I want you to be aware that an economic downturn could be in the midst over the next 3 to 5 years. So with that, I did attach a lot of information in your packet. I didn't intend to include all pieces of that for today's discussion, but it helped me to actually put all my source documents there, and we can refer back to those at any time. I appreciate your attention, and we'll try to answer any questions or receive and take note of your comments.
Well, we'll go through the lineup here.
Cool.
And thank you very much. Outstanding presentation.
Thank you.
Supervisor Johnson, do you have any questions or comments?
Just 2 questions, I believe. One of them for Ms. Lloyd is, you didn't include, I know you said you're not going through everything, but are you still predicting a $3 million shortfall in the vehicle replacement fund?
Yes.
Okay, and then why do you distinguish between contingency and rainy day funds?
Contingency is going to be something that you would plan to budget for every year in the event that you have opportunities before you that come before you, or certain types of expenses that are not associated with it, let's say an unfunded mandate or something. So the items really that you've been making decisions on, so that we have a cost increase in postage, that you need to go out and seek some legal expertise in a certain area. So contingency is what is budgeted and made available to you on an annual basis. We've tried to target a percentage that's fairly typical. The rainy day fund would be on top of that, which would allow you to have like a cushion fund balance. So contingency isn't necessarily part of your fund balance. Contingency is we're annually going to budget $2 million, $3 million, $5 million, something like that, that allows you to have an opportunity to immediately respond to something that's going to happen like this coming year or during the year. The rainy day fund would be additional cash reserve, just cushioned in the fund balance, that allows you to deal with something for 1 to 2 years. So if there were a mandate and we could, that cost was passed to us, we could absorb that for a couple of years and take it out of that rainy day fund, and then you would have to make a decision about whether to continue that service or eliminate.
Mr. Chairman, and how does that tie into operating capital? That we need your $16 million at least to take us through the year for our expenses, and that's part of contingency, isn't it?
For definition at Mojave County, yes. For corals, no, it's separate where, I understand what you're asking though. If we have between $16 and $20 million in reserves, that does include contingency. And it could include your rainy day reserve. We just haven't ever restricted and really discussed the two separately before.
Right.
Thank you. Any more questions, Supervisor Johnson?
No, thank you, Mr. Chairman. I just always considered the contingency and the ready day is the same.
Okay.
Thank you. That's all I had.
Thank you. Supervisor Moss?
My quick observations are this. I had two concerns going into this workshop, and that was the conditions of our roads and the shortfalls we have in law enforcement and the criminal justice system. I've added a third to that, which is the debt that the unexpected debts we've incurred as a result of certain legal issues and pension changes and things of that nature. I think it's something that we're going to have to give serious consideration to, because I don't see us having the revenue as things currently stand to meet those demands. And so we're going to have to discuss what we do in order to generate the revenue to meet those demands, and do so in a way which is the least burdensome to our local voters. And that's all I have for this moment right now.
Thank you, Supervisor Moss. Supervisor Angus?
Just to clarify what Supervisor Johnson was saying and what Supervisor Watson was saying, did we ever have a separate rainy day fund?
No.
Okay, so that was confusing. There was a slide that Supervisor Watson went back to, and it showed where Mojave County stood in relation to the rest of, and you said that we're the second largest, but if you looked up, there were Coconino, which is the largest, they were only 2 up. So I don't know if there's a direct correlation about size and how much the community is taxed. So I just wanted to point that out. And again, we have to come down to priorities and what our priorities are. And then I'm sure we each have our own, and we'll be going through that. But thank you for showing us all of it. Immediately I wanted to slit my wrist. So, I'm hoping it's not all that bad, but, I know it's your job to kind of show us all the worst cases. And it was very interesting. Thank you.
Thank you.
Supervisor Bishop?
Well, I just can't imagine what more bad news we can receive, but, we knew this was coming. We addressed all of this last year, and we decided not to raise taxes, and so we didn't, and we spent down some of our funds, and here we are even in worse shape. But once again, I think I'm going to hope the board will support a consumption tax, and along with that, the lowering of property taxes. But I also think we should be looking at the possibility of maybe putting some of this to a vote of the people, and see whether or not Mojave County citizens that don't like their dirt roads want to have a small tax to help us address that with. So I think we have a lot of things to look at. I'm really hopeful that we can figure out in all of this confusion and decisions that we have to make. I would like to see the Code Enforcement Department increased so that we can get a handle on the trash situation in Mojave County. So, and then with the retirement, oh my gosh, that's just mind-boggling. I don't know how it got so bad, and I don't know how we're going to fix that, but let's go to work.
Thank you.
Okay.
I just have a couple
Mr. Chairman?
comments. Supervisor Moss?
Yeah, there's something else that occurred to me while Supervisor Bishop was speaking, and I concur with much of what she said. But is Mr. Latosky there?
Yes.
May I ask him a few questions?
Certainly. Okay, he's at the podium.
Thank you, Mr. Chairman. Mr. Wojtowski, I have a couple data points that are in my head, and I want to put them out there and see if they're accurate and make sure that the public is aware of them. The first is that we get approximately, and I'm speaking in rough terms, $12 million a year in HERF revenues, assuming there's no sweeps, but we have roughly $17 million a year in necessary road maintenance needs. So we're running $4.5 to $5 million a year short in adequately maintaining our roads. Is that accurate?
Chairman Watson, Supervisor Moss, that is representative of the ballpark of our revenue. However, I do want to clarify that we are seeing HERF revenues approach the $13 million mark this year. We don't expect a significant increase. In fact, if anything, it may very much just level off looking ahead towards fiscal year 18. Mojave County also receives, for transportation purposes, a appropriation of VLT tax, and that is approaching, if top of my head, is about $1.5 million or so a year. So we're seeing about a $14.5 million transportation revenue for public works and our maintenance of a roadway network system that is over 2,100 miles. As far as the needs, staff has, based on best practices for road preservation and reconstruction, has in the past estimated as much as $22 million a year would be required to actually go about delivering routine operations and maintenance, but more importantly, investing into the capital projects necessary to preserving and reconstructing our existing road network.
So then I stand corrected if I'm hearing you correctly. Our road revenues between HERF and the revenue sharing that you mentioned is roughly $14.5 million a year, and our need is roughly $22 million a year to maintain and restore existing roadways. Would that be an accurate statement?
Supervisor Moss, yes, that would be an accurate statement. The delta is more about $7 to $8 million in terms of existing revenue to need.
Great. Now, the second thing is, for a period of years, our roads have been degrading, and it's my understanding, and please correct me if I'm wrong, that it would take a one-time expenditure of roughly $20 million rather, to get the Mojave County roadways up to adequate standards, uniformly up to adequate standards, and then we'd be back into that revenue shortfall every year unless we had revenue sources increase. Would that be correct?
Supervisor Moss, I can represent a couple of facts based on our rigorous engineering analysis. We do conduct pavement inspections of all of our paved roads, 800 plus miles of paved roads annually, and we have determined from an engineering perspective that about 45% of just our regionally significant roadways, our arterial roadways and regional highways, they number about 300 miles of that 800 miles that we maintain. Just those 300 miles, about 45% of them may have reached the end of their structural service life. On the rideability side, in general, that has shown a little bit better picture. Some of these roads that have reached the end of their service life are still showing conditions that are acceptable in the context of rideability. But to put a dollar value then on reconstruction, yes, I would probably look at focusing on just those 300 or so miles of roads and the 45% of those. So just rough numbers off the top of my head, say 130, 140 miles. Could be candidates for full-on, reconstruction, and yes, that would, certainly incur a substantial investment. Just if you would take a nice round number of say $200,000 per mile, multiply that by about 130, or just for round numbers again, 150 miles. That is a substantial amount.
Okay, so because there is a large one-time expenditure that would be needed in order to get the roads up to snuff, and then we'd be back into the maintenance cycle, which requires roughly 22 million a year. Am I understanding that correctly?
Supervisor Moss, I do not have the numbers penciled out, but getting back to our preventive maintenance activities, yes, we would certainly want to undertake, in our best approach, a weatherproofing chip seal application to preserve these roads to allow them to provide service through their service life once every 5 to 7 years, roughly, and that's an expense that we certainly are not positioned right now. Our current road program for this FY17 only addresses about 4% of the overall paved road network, and so we're not nearly there to where we should be.
Can I ask you, when you have time, which I know you don't have a lot of, to actually put a small paper together on those questions I asked you and provide me a copy of it, obviously to the other supervisors, so we have some more, not, I won't call it specific, but a closer estimate as to what would be needed to both restore and then to adequately maintain as the years go forward?
Yes, of course.
Thank you, thank you, Director Latowski. I don't have any other questions right now, Mr. Chairman.
Thank you, Supervisor Moss. Supervisor Bishop?
Yes, I also wanted to point out that our employees, they deserve and they need a pay raise. And I think while we're looking at everything we need to be looking at, maybe not a compensation study just yet, but at least a 2.5% raise across the board. But we might even, I'd like to, if it's possible, get a report on how the PTO reduction has affected our ability to retain employees or recruit new employees. And I know probation, the sheriff's office, the roads department, the health department, they're really having difficulty retaining and hiring people. So just one more thing to look at in the overall realm.
Thank you. Ms. Lloyd? Fantastic presentation.
Well, thank you.
I'd like to, if I could, just kind of hit a few of the top notes, and if I'm wrong, correct me, if you will, please.
Okay.
I believe in the road department, we have over or right at 100% turnover. Have you heard that fact also?
Yes.
Okay. I see the sheriffs in the audience there. We're running about 70% of capacity of deputies.
A little higher. We have some in the academy and some coming out of the academy with recent hires, but yes, we're still very low.
Still lacking a great deal, correct?
Correct.
Thank you. The last raise we gave our employees was a number of years ago. That was the only raise that we've given in 8 years. Mm-hmm. No wonder our turnover is where it's at. The other liabilities that we have are $20 million in the public service pension fund, about $2.5 million in elected pensions. 45% of our roads need reconstruction. That's 300 miles of roads. We've got a $3 million shortfall in vehicle replacement. Ladies and gentlemen, we have balanced the budget for the last 8 years on the backs of our employees, and we can, if we do nothing again this year, it's one more year. This is the year we need to take a good, solid, precise look at our revenue stream and how it's designed and what it does in the future for us. We can no longer function like this any further. We're at the point now of our organization being at risk. And I just want to make sure that everybody understands that we're at risk as an organization if we continue with this revenue structure. Administrator Hendricks.
Mr. Chairman, I just wanted to mention one other revenue stream that I'm not sure was touched upon that the board can put in their potential playbook or book of considerations. That's to extend the existing quarter-cent sales tax that sunsets in 2019. Also, I'm not sure that we emphasized sufficiently that if we gave the 5 cents back to the TV district and the 10 cent back to the library, that basically our revenues will equal our expenditures of last year. This year's revenues will equal the expenditures of last year. So if the board chooses to do anything additional or chooses to address unfunded liabilities or employee raises, without cutting services, there is no money out there, except unless you want to take from contingency from our cash balance, which is just barely sufficient to carry us through the year. And if you did take it, we don't have a line of credit like the districts do. So I wanted to emphasize that part of the purpose of this exercise was to identify additional revenue streams if additional programs were needed. And when I say that revenues will equal expenditures of last year, we were already receiving requests for additional employees that we're going to be hearing during the budget process. So what's going to be proposed by our administrators and elected officials is going to be a budget that exceeds last year's budget with no additional revenue to cover that. But thank you, Mr. Chairman.
Thank you, Mr. Henry. Thank you very much, Ms. Lloyd. Fantastic job. Really appreciate it. Thank you very much, ladies and gentlemen. I appreciate your attendance and watching this proceedings and learning like we have all learned. And thank you very much.